Good evening, everyone. I would like to extend warm welcome to all of you joining us today from various corners of country and also from the different financial landscapes. I'm Saket Kumar, co-founder of ETFJunction, and it's my privilege to moderate this enlightening session for all of you. Let me just share a brief about what is ETF Junction. I'm sure you must have been hearing about the name ETF Junction. It's basically a fintech platform which intends to provide a complete ecosystem for the entire ETF industry in India. This involves all the stakeholder, which is manufacturer, ETF service providers like stockbroker, investment advisor, influencers, and above all, the investors, right, in India. The endeavor is to solve the underlying challenges which the presently industry is facing in terms of lack of awareness and also the absence of proper infrastructure on ETF, right? And create a platform for smooth and inclusive growth of ETF in the country. Now, this webinar is being presented by ETF Junction's ETF Pathshala. It's basically ETF Pathshala, if we speak, is a forum for sharing valuable insights on ETF and passive investing from industry expert and eminent speaker from the field in India. This being conducted on a regular basis, I think on every month you would have been seeing. And thank you so much for joining today's session. As we progress, let me just give you a sense that at ETF Junction, we are committed to fostering a deeper understanding of exchange traded fund, which is slightly new in the country. As the ETF ecosystem in India continues to evolve and gain momentum, it's imperative that investors are equipped with the knowledge and also insight needed to navigate this entire dynamic landscape, right, which is going to be very effective as we progress. Now, today's topic, as we speak, right, is something slightly more important in today's context, and it holds particular significance as we delve into the realm of smart beta investing. With the advent of innovation, which has happened, right, in the investment strategies and also growing importance of factor-based investing, smart beta strategies have emerged as a compelling avenue for investors seeking to advance overall return, right, with managing minimal risk and also cost-effective, right, in a cost-effective manner. And that's where this particular instrument has been getting used currency globally, and we are seeing early signs of that happening in the country. If we come to today's topic, it is the introduction of smart beta investing. There's a lot of questions which comes to all of our mind. What is this? How does it work? What are the different, fallacies in and around it, right? How is globally shaping up? We have three good, experts to give you a complete understanding about this particular, concept, which we are going to discuss today in detail. Without further ado, let me just introduce our eminent speaker and the panelists for today. The first is Umesh Dalia. He's the head of ETF sales at Mirai Asset Mutual Fund. He heads the sales and distribution, right? Has got an experience of 18 years in the entire financial industry. He has helped earlier the channel management, business acquisition for mutual fund industry, both for retail and banking segment. Mr. Dalia is a very strong and old hand, big pillar for the industry with the various financial services which he has done. Prior to this, which he was working today, was working with Tata AMC as well as IDBI Bank. He's a commerce graduate and holds an MBA degree in financial and marketing. Welcome, Mr. Umesh. Yeah, the next speaker we have is Mr. Niranjan Awasthi. I'm sure you must have heard and known about him and heard. He's got roughly 15 plus years of experience in cost and management accounting from ICFI plus Master Commerce and PGD rank holder from Pune University. He in his present profile at Edelweiss, he takes care of the entire marketing and product. He's been working with Edelweiss Mutual Fund for last 2017 onwards. He's responsible for overall product and marketing strategy for the company. Before joining Edelweiss, he was head of product communication at ICICI Mutual Fund for last 6 years. Before, he was also worked for Nippon Mutual Fund and also ICICI Security and Sekhan. Welcome, Niranjan. The third speaker and the panelist we have is Mr. Sandeep Chavadia. He is the lead for passive business from HDFC Mutual Fund. Mr. Chavadia has got 23 years of rich experience in financial services industry. Out of this 23 years, he spent almost 20 years plus in HDFC Mutual Fund. A very strong pillar, as we see, someone who has helped all aspects of mutual fund and AMC, which is investor servicing, product, business development, institutional sales, and advisory. In his current role, he is responsible for the growth and development of passive business for the company HDFC Mutual Fund. He's a qualified chartered accountant and BCom from Mumbai University. Welcome, Sandeep. Just to put the context, right, as we progress, we look to gain valuable perspective from all the three panelists with their rich experiences in this particular segment of passives, and would request all the participants to keep sharing any questions which they have at any point in time. The same will be answered at the end of the session by expert panelists which we have here. Now, just to set the context at this point in time, I think there has been huge innovations as far as the investing is concerned. And presently, as I speak, in India, we are having a really one of the best times as far as investing is concerned. We were just having a peep into data of March 2024. I think it has been a fabulous run. We are the entire AUM of the mutual fund industry. It stands at roughly around 53.40 lakh crore, right? And we are really gunning for a 100 lakh crore AUM, and it just looks like that couple of years, maybe 5, 10 years, we are away. And if you just look back, I think we were January 2000, we were 1 lakh, roughly around 53 times growth, right, which we have seen in 24 years. This is a fabulous, maybe participation by investors and the kind of increase which we are seeing in the AUM. And this just not restricted to the, that number. If you look at in terms of the participants, in terms of unique folios, which we right now have, as of March, it is 4.5 lakh crore approximately. This clearly tells a story that people are shifting from, traditionally, fixed, maybe financial product to the real financial product. And that's where real estate and other things are taking a back seat. Now, this is just one side. If you look at, there are good movement happening even on the other pasture, which is the passive. That has grown in just 1 year, which was roughly on 6.7 lakh crore to roughly 9.09 lakh crore by March 31st. That's the kind of growth which this industry and this new kid on the block is seeing, right? This is something which is very important to see, that, people in India at this point in time are looking to, participate in the alpha, and also with a, passive in place. This is something which is completely, maybe relatively new to a lot of investors who are part of this webinar, that what is smart beta investing? How does it work? So today we are here to understand this entire, and with that thought, let me just pick up the first question with Mr. Umesh Daila. What exactly is smart beta, Umesh, and how does it differ from the traditional index investing, right? Just for the very layman investor or a part of this webinar, how do you really share this entire concept to the investors? Umesh.
Yeah, Saket. First of all, thank you, Saket and ETF Junction for having me on the show. So yeah, actually, when we talk about smart investing or smart beta or factor investing, it is not a new word for that say, because it was coined. This particular term was coined way back in, I think, 1970s by Towers Watson company. There was a firm which coined this term, and from that day till the time the first ETF, smart beta based ETF, got launched in 2003. From 1970 till 2003, this term is being used, but at an individual level. So the smart beta per se came into picture in 2003, I must say, from a product launch perspective. But when we talk about smart beta, this is basically a way of investing or selection of stocks, which traditionally we have seen active side fund managers has been doing, like using the growth or a value or you can say dividend yield kind of factors, on the basis of which they select the portfolio, the stocks. So the similar kind of portfolio, similar kind of approach, if you put in a rule-based manner, which comes under smart beta. So smart beta, in a nutshell, if you talk about it, it's a rule-based investing strategy which basically combines the principle of actively managed funds, like active management, where we stock selection happens, and we have been, and that's the beauty and the difference is that in a actively managed fund, it again the subjective to the fund manager. Like we have seen funds where fund starts with a growth strategy or a value strategy, and after some time we have seen many examples that the fund gets changed, the strategy gets changed, maybe because of fund manager moving, or maybe because of this overall strategy going away and all that. But in case of smart beta or a rule, the rule is forever. Like we say, index is forever. So the rule is also forever. So you can be rest assured that whatever rule you have put in for a selection of a particular stock for a particular index is going to be there for the life of that particular fund. Now, it is different from a normal traditional way of investing or index in investing, because when we talk about index investing, we select stocks on the basis of free float market cap. And on the basis of that, the stocks are being selected, and that's where the plain vanilla index works. Now, the smart beta is another layer of creating, on the basis of that plain vanilla index, how you create another index which is better in terms of stock selection, which is better in terms of different aspects, because every smart beta has a different cycles. So keeping those cycles in mind, the filters are being put in, and the stocks are being selected, and then on basis of those filters or factors which are predefined, the stocks or the particular index is being managed. So it is different from a traditional way of investing, because it is beyond the free float market cap selection. It combines active as well as passive, both flavors are there, because the selection happens on actively basis, and the way rebalancing happened, you can see the stocks are being rebalanced quite actively. So it is a one step ahead of you can say traditional investing. So now there is a active investing, there is a passive investing. So I must say there is active investing, there's a passive investing, and there's a factor investing. So now this is a one step ahead of what we talk about passive investing.
Thank you, Miss. Thank you so much. So clearly you're saying that India, which has seen a huge amount of participation in the active and seeing some bit of participation, fairly decent one in the passive, this lies somewhere in the middle of them, right? So this is a new option being thrown to the investor where they can really look forward to gain alpha, keeping the passive theme in place. The next question we have from Mr. Niranjan Avasthi. There are different strategy being spoken of. We've been hearing about momentum, and if you look at globally also, this has really gained quite a big stature. Just to give you a sense that today the global industry is roughly around 13 trillion, or roughly around 13,000 products are there listed across different stock exchanges, which are 18 number. No, the traditional products are roughly 80%. Earlier, what was happening, that smart beta used to be largely a market-driven product, but now it has become almost a natural product, getting roughly around 20.5% market share. So that is the kind of stature it has gained globally. We are seeing the early signal. We would like to understand from Mr. Niranjan Avasthi that what are the key strategies or factor that smart beta typically use to construct their portfolio, right? What are they? How many of them are? And how does smart beta investing aim to outperform traditional market cap weighted indexes? Niranjan. Niranjan, you're on mute.
Yeah, sorry. Can you hear me?
Yeah, you're there.
So as Umesh put it very simply, smart beta is basically overlaying investment strategy over and above your normal indices. So we have been seeing, a basic market cap based indices for many years, whether it is Nifty 50 or Sensex, which is, culmination of 30 stocks. Traditionally, smart beta strategies overlay broadly 4 to 5 factors over and above these normal indices to create smart beta indices, which are single factor. So one is value, there is momentum, then there is quality, then there is value, and then there is low volatility as well. So these are, typically some factors globally which have been used. And using these factors, a single factor indices are made from the base market cap based indices. Then there are multiple variations using these factors, which we call it as multi-factors, because we need to understand factors in itself have cyclicality in terms of performance. So in a layman's language, I would like to put it like factors are like sectors, in a very layman's language. So if you invest in an IT sector kind of fund, it will have its own cycles. Like that, likewise, if you invest in a momentum factor, there will be periods where momentum as a factor would do well in the market. There would be period where it may underperform. And that actually has given birth to multi-factor indices, where you mix momentum with low vol, you mix maybe value with low vol and multiple other factors to create, with factors that complements each other to create an strategy or an index that performs across cycle. So you have single factor indices and then you have multi-factor indices. In India, if you see, we have, barely started understanding single factor indices. Like momentum over the last couple of years has gained some traction. We have seen largest factor-based I would say index funds or ETFs are based on momentum today in India. Then maybe low vol again as a factor is gaining more traction because you get market beta through market cap based indices. But then if you want to reduce volatility of your portfolio, you add a low vol smart beta index strategy to your portfolio. So likewise, you can have these different strategies. Roughly, value, we all know value is basically taking stocks which are undervalued on a relative basis. Momentum works on a strategy which is a traditional strategy that stocks that have done well in the past would continue doing well in future. Low volatility is basically trying to sail smoothly, buying stocks that are low on standard deviation, and so on. So these are kind of, some very basic factors that are there in India at the moment. And I think so investors are just getting acclimatized with them and started to invest.
Thank you, Niranjan. Clearly stating that there are different kind of factors, could be size, could be dividend yield. What has gained a lot of popularity as far as India is concerned is low val. Momentum is making a lot of noises. So clearly, these are the ones just for the convenience of the listener that there are. If you take one factor, it's a single factor, and if you take two or more, it's a multi-factor. Globally, we have seen that out of total size, 50% is a multi-factor and 50% is a single factor. Thank you, Niranjan, for giving a good understanding about that. I think in India, we're clearly seeing at least this three factor, which is momentum, low vol, and also equal weight is gaining a lot of currency as far as the AUM is coming. Coming to the next, I think, we already had, passive, we had active. So what are the advantages this particular one is going to give, or, how does it compare to passive investing? Sandeep, the question to you is, what are the potential benefits and drawback of smart beta investing compared to the active or even the traditional investing, which is the passive investing? Can you provide examples of popular smart beta strategies, maybe in India, which has really made a difference? Sandeep.
Hi, Saket. Thanks for having me. Thank you, viewers. As both the panelists have mentioned, that smart beta strategies are becoming popular in India, and the investors are seeking them out, and so are the distribution community, because as you know, active funds rely on the past performance of the fund manager, and passive products are very useful for taking a view-based investment call in the market. And keeping in mind that kind of a requirement, smart beta is something which refines that requirement even further with a factor. So investors who are looking at gaining from a bull market or a market which is doing well, they would select a momentum investing strategy, and they can participate in the upside of the market with a momentum strategy, because it is inherently shortlisting stocks from a universe based on the price momentum which is there in the underlying stocks. And this has gained popularity over the last 3-4 years as the market has been in a bullish phase. So the advantage is that you get to, kind of based on your particular requirement and your comfort level, select a strategy which you feel will help you gain the targeted rate of return that you are seeking. And that would be the advantage of that. And similarly, if an investor is unsure of the markets and is basically wanting to capture the market return, but at the same time, they are seeking lower levels of volatility as compared to the broader markets. So in times when maybe markets have hit a peak and there is a lot of news flow which can make the what do you call indices volatile, they can look for a low volatility strategy. So keeping in mind these objectives, an investor can plan, or an advisor can plan or recommend to their investor a particular strategy to, gain their targeted rate of return. So that's the advantage of these particular factor-based themes. Secondly, they are all what you call uh, what you call based on a rule. There is a rebalancing which happens at frequent intervals based on the underlying rule, and all these strategies of smart beta investing, there is a what you call weightage given to even the risk management in that particular product. So there are factors like standard deviation which are used to measure the volatility, and basically the smart beta strategies aim to give better risk adjusted returns than the plain vanilla indexes. So that is the advantage of it. And however, they are also cyclical in nature. Just like active fund returns are cyclical in nature, and a lot of macro and micro factors are involved in selecting a particular strategy at a particular point of time. And if in certain market conditions, if somebody selects a factor, what you call, which is not going to perform in line with what it is designed to, then you may have also that a possibility that the returns or the experience of that particular fund may not be up to the expectations of the investor. So those kind of what you call drawbacks are there, and a lot of the factor indices investing in India is pretty new. There is a lot of back tested data which is there, like going as far as back as 2005, to kind of show the pattern of the returns of these various factors. But if you go to see the actual track record of these style of investing is barely 3 to 4 years old. So there is a lot of live market conditions in which one has to see how these factor style of investing actually plays out. So one has to keep in mind those factors while investing in these products. It is not like it is a solution for all kind of markets, but uh, what we have seen is that there's generally more acceptance of these strategies both by the investors and the distributors in the mutual fund what you call ecosystem. And I think the current benefits of selecting such a strategy outweigh the shortcomings which are present in selecting such strategies. And there are other products like value, quality, and growth, which depend upon the fundamental style of investing which a investor is comfortable with. So those parameters are used for selection of these stocks, and a lot of what you call filtration level is there in these rules which are laid down to select that strategy. There are stock level limits which are placed there, and uh, basis all these factors, I think a lot of the risk management is also addressed in addition to the potential return that a strategy can generate.
Thank you,
So
Sandeep.
I think that's a what you call a great option for the investors and distributors both.
It was quite elaborative. Thank you, Sandeep, for clearly giving that there are advantages this instrument has, and also the drawbacks. But the advantages obviously covers the drawbacks with a big margin, and that's why the popularity is really increasing. As we go, if this product is being really being used and lapped up by HNIs, right, PMS providers, right, we have seen it getting into all the larger investors. The big question here: does it also really has a space for the retail investor, right? Does it also is this product needed in the portfolio of all kinds of investor? So the question to Umesh, right? How does smart beta fit into the diversified investment portfolio? And here we're talking about the people who are listening, right? The participants, is it suitable for all types of investors, right? And what are the costs associated with it? Is it more, or is it less, similar, investing in smart beta ETF, and how do they compare to the traditional ETF as far as the cost is concerned? Umesh.
Yeah, I mean, when we talk about investing, it always comes with, and we have been advocating it quite a long, that it should be linked with your goals. While investing in any kind of investment vehicle, you should always consider your risk profiling, your you can say understanding of the product, and all things. Everything applies here also, because as I said, and every panelist has said the same thing, that the smart beta itself is a one step ahead what we have been doing historically, traditionally. So smart beta is a kind of products where you can create product tailored fit for any specific needs also for the client. So first and foremost thing for any investor who wants to participate in a smart beta, he or she should be having a detailed or good experience or understanding of capital market, point one. Because as we all know, and we have been saying also, that every factor has a cycle. So cyclicity is there, and keeping that cyclicity in mind, there are two ways to invest. One, you can do a tactical call, but for that, investor should have a well in-depth experience of capital market. So then they can choose and time the right factor at the right time, and if they pick it up, and for a shorter period, they can do a tactical call also. And if any investor who doesn't have that sort of experience and still want to participate in these kind of factors, they can always go for a longer period or long-term investment horizon, which generally stays for 5 year plus. So there are products like, say, and as I said, every cycle has a product. Like if there is a bull market, we can always go for alpha or a momentum based factor. If there is a lower bearish market, we can always go for a low volatility, or in some case value, or some case quality, if that the bearishness stays for a longer period. So every cycle has a product. Investor has to choose which product is suitable for him or her. If he or she is not able to take an advice or decision, they can always consult an advisor also for that, because advisors will help you keeping your risk appetite in mind. So that is where you can always go for these kind of products in mind, because in India, traditionally, we have seen still funds are being bought on the last 1 year's outperformance, and funds are being sold on last 1 year underperformance. So for a smart beta investing also, I must say that please look at a longer horizon. Always look at data, which is thankfully in case of smart beta is available from 2005 onwards, and you can just look at in different market cycles which factor did what, sorry, and then depending upon that, investor can take a call. Now, coming to the cost part, it is basically obviously smart beta or any passive product for that matter. It is quite cheap in terms of cost, as if we compare it with actively managed fund. But it is little costlier than the traditional ETFs, because of the factors or filters you put in. But from cost perspective, it comes in between our plain vanilla traditional ETF and the actively managed fund. So from cost perspective, it always gives a upper hand for clients' portfolio to decrease or to rationalize the overall cost of the portfolio. Also, nowadays, if you look at, we have been seeing a lot of smart beta products are coming in. Now smart beta is available on a large cap, smart beta is available on a mid cap, mid and small cap, small cap. So everywhere you will see smart beta products are there, factors are there. Investor can wisely choose and take a call depending upon how the portfolio is being completed. If any because today also, if you look at any portfolio, there are misouts. There are misouts because there are segments where products are not there. Now, I think smart beta will help investors in terms of fulfilling and completing their portfolio, not completing, at least heading towards completion of the portfolio. So I think it's a product which is suitable for HNIs, ultra HNI institutional investor, as well as from a retail investor also.
Thank you, Umesh. So clearly, the clarity from your end on the cost, and also clearly one has to look at the goal, right? What he has, and also the kind of risk he can go for. Obviously, it can get into every portfolio. Thanks for sharing, Umesh. Now, the next question is to Niranjan. There are a lot of misconception and myths about smart beta, as that product itself is slightly new, and also there are a lot of thought process which has been going. Just wanted you to clarify, and for our audience, that what are the myths which are prevalent, and also if you look at how does start smart beta investing align with the different investment goals, and also the risk tolerance. Niranjan.
Right. So one thing, one common myth which I come across is smart beta is very complex. But I don't think so, because it is as complex, I would say, or as simple as a normal Nifty 50 index, the way it is constructed. It is only one or two more factors apart from market cap which gets added while selecting a stock. In fact, when you look at an active fund, there are so many things that a fund manager looks at before selecting a stock. And in fact, here it is only maybe one or two factors. So it is not complex. That is the biggest myth. It is rule-based. Of course, you don't need to know, what are the formulas behind it. And in fact, even if you see, these are very simple, like low volatility, while people may feel it is a super complex thing, it just looks at the standard deviation. And maybe if it is momentum, it is very simple. It just looks at last 6 months and 1 year price movement of a stock along with market cap. So it is not complex. It may sound complex, but it is not. Second, I think so, the myth is also it is not for a beginner or not for a layman investor. That is also not true, because once you understand the factor, once you understand that in your portfolio you need to reduce risk, and by having a low vol factor index strategy, you can reduce drawdowns, you can reduce volatility in your portfolio. It is right for any retail investor or HNI investor. In fact, it can be part of your core portfolio as well, if the objective is that. Next, you ask, how do you align these strategies with your goal? So
Right.
smart beta actually, while you may have a normal diversified index fund or even active fund, smart beta is built, or gives you diversification benefit. Like in India, most strategies are growth oriented. And if you want to diversify, you can have a value based smart beta strategy in your portfolio. It will complement your existing portfolio. If you have value, or if you have a normal strategy, you can add a momentum flavor also. If you are an aggressive investor, and if you want to go all hog when markets are doing very well, maybe momentum is a strategy where you slightly improve your risk return profile of the portfolio. You take a slightly more risk because the beta usually is higher, and you can get that additional returns also in your portfolio. So goal has to be like in traditional, what is the time period of your goal is important. But when you are adding smart beta, the goal is more of what kind of risk return profile you want to achieve in your portfolio. And then it aligns with any of your goal, even if you are investing for 10 years or 3 years or 20 years. Risk return alignment is what a smart beta offers, I would say.
Thank you, Niranjan. I think clearly sharing that misconception of being a very complex product, and maybe the different products, how can they be used at different point in time in different portfolios. Thank you, Niranjan. The next question to Sandeep is the fact that we have seen, and especially momentum, which has really made a huge, not only into the passive part, but also in the active, is making a difference as far as the market is gaining, traction every day, moving up. The big question is that does this particular strategy works in all market condition, right? Are there instances where it is also done well in a downward market corrections, right? So the question to Sandeep, how do these, the smart beta work in different market condition, and different aspects like higher volatility or different economic cycle? How do they impact the performance of smart beta ETF, and does it deliver better return in all market conditions? Sandeep. Sandeep, you're on mute. Sorry, you're on mute, Sandeep.
Yeah. So, smart beta products also have to be used tactically while making an investment at a particular point of time in the market. However, they can be also held as long-term investments once a decision is made on which particular strategy the investor is chosen. But there are certain cycles which favor certain strategies. Just like, you have active fund managers who do well in a particular type of markets. Like there are value biased fund managers who do well when, interest rates are high, and the low PE stocks tend to do better as compared to the high PE stocks. And even in low interest rate environments, where the risk is on, the growth stocks tend to do better than, the value stocks. So these cycles keep coming and going. And in smart beta, we have these, popular strategies in India like momentum, low volatility, value, quality, and growth. So they will also outperform the market at different junctures of the market conditions. So momentum could do well when market conditions are very good. There's a broad-based rally across market caps, across sectors and segments, and that's when momentum does quite well. Uh, Low volatility could do well when the what do you call, there is a lot of volatility in the market, but the low vol strategies exhibiting much lower relative volatility than the broader markets, and investors will have a lower downside in times of where there are very significant corrections in the market, or what do you call, it's able to provide a little more stability in the portfolio as compared with the broader markets. Value strategies can do well, like how it's happened in the last 3 years, ever since specifically when the Ukraine war broke out, there was a period of high inflation and interest rates were high. To combat that, so value strategy paid off in a very big way. So, it could do well in such time periods. Quality and growth do better in what you call it, because they relatively have a higher PE multiple than the normal market. They would do well in lower interest rate scenarios, or when people are seeking out high quality businesses, or they want certainty of earnings, then they opt for such strategies. And prior to COVID, we had seen that strategy, both in active, also do exceedingly well. So one has to look at the market conditions, or the advisor who's advising the investors have to look at the market conditions before recommending a particular strategy. And yes, if say even the momentum strategy, which has done very well in the last 1 year, the I think the Nifty Momentum 200 this 30 index has given a 70% return in last 1 year. But the year prior to that, when markets were kind of flat and not doing that well, and they were slightly biased towards the negative side, the momentum strategy did not do that well. So one has to keep their eyes open and look at these strategies from the point of view and when to invest in them. But if your investment horizon increases, then these strategies have been shown to be all-weather strategies. The more your holding period return, as they say, time in the market is also important than just timing the market. They are able to overcome these cycles and deliver the alpha over the plain vanilla index funds on a risk adjusted basis as well. So your time horizon matters, your return expectation matters, and the particular market conditions also will play a role in that strategy playing out.
Fine.
So one
Thank you.
has to have a mix of all these factors while selection of the strategy.
So essentially what Sandeep is saying, that it works in all market condition. It depends which particular factor you're choosing, or which particular multiple factors you're choosing, but it has delivered a good return in all kinds of market conditions. So that is where it is. Thank you, Sandeep. Coming to the next question, I think, if you look at the global market is linked, right, all across. And what we have seen, the daddy of the global market, USA, really, gives you a trend, how things are shaping up. As we speak, passive really has had a huge run there. Roughly around 54% of the market size of the entire mutual fund industry is in passives. Now, important to understand, and especially from Umesh, who represents Mirai, which has got a very strong global presence, right? How does and how has Smart Beta Fund shaped up in the global market? What are the trends, right, there among global investors towards these funds, right? What all we can learn from them for the Indian investors? Umesh?
Yeah, I mean, yeah, so globally we see from a passive perspective, overall the global markets, especially the developed markets, are way ahead from markets like India, where we investors are more evolved. They have been using passive strategies for different needs, starting from rebalancing to short-term parking to multiple ways to use it. So globally, as you rightly said, Saket, at the start of the conversation, that we are hitting $13 trillion size. So as on March 24, end of March 24, the global passive AUM reached to ETFM reached to around $12.71 trillion, which is a phenomenal number, phenomenal growth, I must say. But if you talk about within this, if you talk about the popular category that have got a lot of traction from investors, there will be two popular category lately we have seen. One is smart beta and another is active ETFs. So active ETFs are not here in India. So smart beta is slowly and gradually has started taking a place in India, but still it's a very nascent stage, I must say. At the end of February 2003, February 2024, if we talk about, there are around 1,330 ETFs already, equity-based smart beta ETFs are already there, which are coming out of 30 countries, where around 40 exchanges, 48 exchanges, these ETFs are already listed. There are probably around 200 plus ETF providers who have been running these kind of strategies. The category overall has grown with around 19% plus in last 5 years. That's where I must say, phenomenal growth from that perspective. The main change, the game changer, and not only if I remove US also, other than USA, if you look at other countries, the new age investors, the new generation who are now taking charge, are pretty keen towards these kind of strategies. Traditional investors are to coming also coming, but the new age investors are lapping these kind of strategies a lot, and they are very much interested, and because of which we can see globally this trend is going up, especially say in US, Europe. The smart beta has become the popular one, and in India also we can see right now, though we are at a very nascent stage, we can see it is following the global markets also. So it's a quasi active kind of strategies which globally investors are using, and numbers, as you can see, are quite evident in that sense.
Thank you. As I clearly stated, and thank you for sharing this entire data very well, shared, is that this space is evolving. I think a lot of innovations are happening, and at this point in time, I think what Umesh was sharing, that active funds globally are also gaining a lot of traction, and clearly there is a trend which is showing that people who are new to the investing and also the new millennial investors have got really a good appetite for such kind of product. Well, thank you, Umesh, for that. Coming to the what kind of flow this particular segment is getting in India. As I spoke, that roughly 9.09 lakh crore as on 31st of March 2024, the total assets in the passives, right? What are the flows, right? How are they? And also when we look at which particular factors has really attracted attention of the investors. So the next question is to Niranjan: how are you seeing the fund flow in this category in India so far? And also, are there any popular trends that is being seen in the Indian market in smart beta investing? Niranjan.
Right. So largely, if you look at the AUM pie, of course, 95% of the AUM, or rather, 90% of the AUM is into Nifty 50, Nifty Next 50, and large cap oriented market cap based indices. Smart beta today is a quite small percentage of the overall pie. The reason is these funds have launched only recently. Because most of these indices, in fact, were launched recently, as Sandeep was alluding to. It's only last 2-3 years where we have seen smart beta indices coming up in India. Some of them were there, like low vol is one of the very old indices, and there were some funds. But 2-3 years back, people were just getting flavor of the basic index funds and passive funds. I think so last 2-3 years, people have understood what an index fund, what a passive fund can do in their portfolio, what are the benefits. And now they've started exploring smart beta indices. And incrementally, I think so, the flows will increase towards, of course, your normal market cap based indices will be a larger part, and people who understand the benefits will start coming into it. Some popular smart beta strategies that we've seen as momentum is clearly one of the very popular strategy out there. uh, you know Nifty 200 momentum strategy was first one to be launched. Then we at Edelweiss, we launched Nifty mid cap momentum strategy, which has seen a lot of traction. And couple of other, like low vol is again a very popular strategy. Equal weight is again a very popular, I won't say a pure smart beta, but that is also one of the factors which comes under smart beta because it cuts into size. So equal weight is also one of the very popular factor which is gaining traction. So these 2-3 factors, momentum, low vol, equal weight, these are 2-3 strategies which are seeing incrementally higher flow compared to many other strategies, especially on the smart beta and multi-factor or single factor strategies.
Thank you, Niranjan. Sandeep and Umesh, I'd like to bring you here. What kind of flows you're seeing? Is it restricted largely to the larger cities or also to the B30s, which is beyond top 30 cities? Is it across segment? Would you just like to share some insight there, Sandeep?
Yes, this the strategy is popular in large cities as well as smaller cities. In fact, I was quite surprised in looking at the data that a lot of IFAs who are present across the country, uh, they know some of these popular strategies very well. And in one of our recent new fund offerings, they were also a large contributor to the flows across the country in getting money from these strategies. And I have spoken to a cross section of IFAs across cities, while interacting with them, and they're very familiar with strategies like momentum and equal weight, as Niranjan was mentioning. These are the very popular strategies, and as you have seen in news reports that the number of demat accounts which are being added in Uttar Pradesh is was for some time has been exceeding even Maharashtra. So I
Interesting.
think the the digital infrastructure has made
Very, very.
information available to all, and I don't think there are those barriers which were there earlier in new ideas being accepted across new segments of investors. So I think it is, following the what you call path of active funds, which have equity funds, which has played out that B30 is increasingly becoming a very big source of flows coming for these kind of strategies. So I think that has started. We can see evidence of that, and I think this trend will become stronger only with time because a smartphone is available to everyone, apps are available to everyone. So it's become very democratic. So I think it's a very broad-based and well-accepted strategy, and these will become more and more popular over time. Is what I think I can gauge from what response we are getting from investors and distributors both.
Interesting insight, Sandeep. Thank you so much. Umesh, would you like to share? I think you're on mute. Could you like to share, your understanding and your experience of the product's penetration in the country?
Yeah, I think I agree with Sandeep on this, that this is something which is shaping up. But I would like to add few pointers here. See, India, if you look at India, India is a structural growth story. It was structural growth story in 2007 also. It is structural growth story in today also. I think we are lucky in a country like where we have been seeing this growth stories keep on going. And I think at 75,000 level of Sensex also, people are talking that it is way ahead. We are way behind if you look at 7 trillion economy from that perspective. And during that time, when people have confidence in a country like India and where we launch a smart beta on a plain vanilla kind of indices like a large cap, mid cap, and small cap, where people can relate to, I think in those kind of products we get more traction, because people are understanding that what small cap can do to do their portfolio, or what mid cap can do to their portfolio. I think we as a manufacturer will keep on adding these kind of ideas, keeping investors taste and thoughts in mind. And I think we have just started. Right now, I must say in my case, primarily, obviously, it is little tilted towards bigger cities, but slowly, gradually, like we launched something on small cap, and now so these kind of products which people B30 can relate. I think advisors are also trying to put in some money, and now we have seen interest is growing. In the smaller cities also, city like Banaras is giving us allocation, or a Patna like giving allocation in these kind of markets, or for that matter, Udaipur is giving. So my point, what I'm trying to say is that these kind of markets which were primarily traditionally investing into large cap or a large and mid cap kind of actively managed fund, now they are slowly, gradually graduating towards these kind of products.
Thank you. Pretty interesting. I think clearly these are very early days, but it has made its impact. It's just a matter of time. Niranjan, I think you're coming up with something interesting, right? Is in this particular space. Would you like to share something on that?
Yeah, I mean, we were looking at the large cap space, and if you look in perspective, if you see the total size of passive funds today, 80-90% is into large cap space. And even on the active side, actually, if you see, the largest AUM is in the large cap category. The large cap category AUM is roughly around 3 lakh crores. If I'm not wrong, it'll be closer to that. And the large cap related passive fund AUM, ETF plus index fund, is upwards of 4.5 lakh crore. So if you see in that context, in the large cap category, passives are much larger today in India. And we thought, how can we add more value in this space? And then we thought of launching this a very nice index from NSE, which is Alpha plus Low Vol. Because Alpha, tries to give you a good participation when markets are doing well in a bull market, while at the same time, Low Vol as a strategy keeps you under check when markets are not doing so well. So it's a complementing factor, and with this we saw that it gives you a good returns across cycles, because as I mentioned, even all single factors will have their own good times and bad times. When you complement these two factors together, it kinds of reduces the cyclicality of factor-based investing, and these two factors are actually acting complement to each other. And when we looked at the data, it showed that in the large cap space, this strategy is generating huge alpha over maybe a Nifty 100 plain vanilla market cap based index. Over the 10-year and maybe 15-year period, it has generated an alpha or an excess return of almost 3 to 4%, which is quite healthy and quite good. So investors who are looking in the large cap space, this is an additional choice for them. They can graduate from a normal Nifty 100 or Nifty 50 index based investing to a much more evolved smart beta index, which is not complex, as I mentioned, but at the same time it adds more value to your portfolio.
Thank you. Pretty interesting. Coming to the last question from Sandeep, as you rightly said, Sandeep, that India just stuck to the story, and today only I think DSP owner Mr. Hemendra Kothari stated that India has never seen next 10-year better in my lifetime. This is the best 10-year I'm seeing. There's just one statement. I think recently I think Zerodha owner stated that when your prime minister is making a statement right on economic nuances and the target, look at where things are going to be. So there's nothing better than what we would have ever imagined the way we are placed as far as the entire economy is concerned, and this is acting as a proxy to the most popular investment. If you look at the 3 lakh crore we are talking about, 80% is your equity, right? And this is a proxy to the active investing. So just to ask from your perspective, where do you see the future of this particular instrument in the country?
You're talking about smart beta products,
Smart beta products,
specifically. Yeah, so I feel that as Niranjan had just pointed out, that a lot of the strategies are now focused on the large cap universe, which are the top 100 stocks in India currently, and they constitute, a majority or a major part of the market cap of the Indian indices, so to speak. But I think these strategies will keep evolving. They'll become more popular, and they will go down across market caps, as they will look at mid caps, they will look at small caps, and smart beta will also involve selection of different sectors at different points of time of the cycle, looking at the macroeconomic or the microeconomic situation which is there. So people will select different sectors and maybe apply the factors on a particular sector also. So this can happen because as the sectors become very large, like banking sector and IT sector is very large by market cap as a contributor to the Indian stock markets, people would apply multiple factors on these kind of what you call sectors as well. Just to give you an example, and maybe smart beta would combine with commodity funds also. So this can be used in various different styles of investment, and all this actually is very common. Like quant investing is very big overseas, and the smart beta is like the first stepping stone to that quant-based investing, which is becoming popular in India, where people want to take out the cyclicality or have a strategy which is able to adjust to the very market conditions. So if you see the recent history also previously, I mean, since we've been for a long time in the capital markets, previously cycles used to last 3 years, 5 years. And now cycles are so short, they last 3 months, 6 months, and things keep changing and keep evolving. It's very difficult. I mean, in October, people were talking about the Fed pivot and that interest rate cuts are imminent in this year, and everybody was positioning their portfolios according to that. And suddenly now, after a few months, we feel that the first rate cut is not going to maybe happen in March, not going to happen in June, and the rates will stay higher for longer. What will happen? So, these things are very dynamic. This is a very volatile, uncertain environment, and the smart beta strategies, quant-based strategies will help you navigate these times and these different conditions in the market, and they will definitely become more popular. And as there was a mention of even active ETFs becoming popular as a part of this. Those things are also going to take off in India in a big way. So I feel that this ecosystem is going to keep developing, and it's going to mimic what has happened in the developed world, like in US and Europe, where these strategies are pretty popular, and there is both retail and institutional participation in these strategies. So I think that is going to play out over the next 5 to 7 years, as you pointed out. India is in a very sweet spot where our growth rates are as they say, the oasis in the desert. If you look at the global economy, for this size of an economy, our growth rates are really fantastic, and growth is surprising everyone on the upside. And I think these things will definitely pick up because the market will become broader in size, it will become bigger in size, and people will want to explore newer themes or better ways or more efficient ways of investment. So
Really,
I
innovation is
think
going to be the leader. Yeah. Thank you, Sandeep.
correct.
We have completely run out of time. I'm so sorry, won't be able to take any question. Thank you so much, all the panelists. Thank you so much, all the participants. It really makes a lot of, I would like to give a sincere thanks to all of you for, being a part of this entire webinar. Hope really it made a difference and gave a good understanding about this completely new product, and hope it really helps you enable investing in the product. Thank you, Sandeep. Thank you, Umesh. Thank you, Niranjan. We'll really look
Thanks,
forward
Saket.
to having more such sessions in
Thanks,
future.
Umesh and Niranjan.
Thank
Thank you.
Thank you so much.